Great, great. Awesome. So let's go ahead and do some of our introductions here. We're not going to use the video the entire time because it does make a little bit of a lag sometimes in the actual video feeding when we're trying to stream it live. So I want to thank you and welcome you to our live webinar with the Multifamily Investor Nation. We started this Multifamily Investor Nation group about 3 weeks ago now, and we're already over about 1,200 members, almost pushing 1,300 members in 25 different groups across the country. So thank you for all the co-organizers who have helped us out to be able to grow this platform and grow this Multifamily Investor Nation. We're going to continue to bring you high quality content and webinars. I specifically selected Yon. I've been following him for quite some time now, and he was one of the first persons that I thought of when trying to create the webinar platforms here. So thank you for being with us here today, Yona. If you can get us started a little bit and kind of tell us a little bit about your background and what you're doing right now with Madison Specs.
Sure. I think, first of all, I'll stop the video also just for the sake of the bandwidth, but I really appreciate it. Really appreciate it. Dan, also been following you for quite some time with the starting of your new podcast recently, the Tough Decisions for Entrepreneurs. A little bit about myself. I'm with Madison Specs, and I'll get into that a little bit. We're a national cost segregation firm. We actually have a number of other services based out of Lakewood, New Jersey. We have a number of offices in New York City as well, Dallas, Houston, Cincinnati, Atlanta, and growing to a number of other locations. And we service title, insurance, cost segregation, a number of other services. And what we're about myself a little bit, I have a very long background of teaching, so it worked out great to do podcasts and webinars and stuff like this when it comes to cost segregation. It's a very amazing topic. You're going to all find out a lot more than you ever knew on this subject tonight, I hope. And just to remind everyone, there is a chat box over here if anyone has any questions, and we will be getting to them at the end. If throughout the segment, if you have a question, I may not get to it right away, but we will come back to them at the end. So it will be worthwhile to jot it down. You tell me, Dan, when you want to get the ball rolling. And
yeah, so I think what we should do is, obviously we've done our introductions of you, Yona. Most people who are joining us know a little bit about myself. I have Brandon, our acquisition specialist, with us with the group that I have called Hanford Capital. So Brandon, I want to turn it over to you for a few minutes while we wait on just a few more people to join us, and before we dive into Yona's topic here of the cost segregation, and tell the listeners a little bit about your background and where your current focus is as well.
Sure. Well, welcome everyone. Glad to have you on the webinar tonight. Glad you joined us. I'm interested to hear what Yona has to offer us. As Dan said, a little bit about myself. My specialty is the property itself, the actual physical property. So my background has been in construction, in residential construction. I was a contractor in the Greenville, South Carolina area. Up until 2008, at which point I switched into the insurance field. And I've been working as an independent insurance adjuster from that time up until recently. And so that's what kind of gives me the background and the property knowledge and estimating background to help assess these properties when we go and look at them and see what type of value add there is and what the cost is going to be.
Great. And one of the things I want you to talk about a little bit too before we dive into this is some of the stuff that you do with your drone, because I know it's been very valuable for us and some of the deals that we've been putting under LOI and things like that. So talk to the listeners a little bit about what you're doing with the drones and how that impacts what you're doing.
Sure. So I use a estimating system called Xactimate. I have an annual subscription to that software. That's what I run all my estimates through. It has multiple features. One of the features that I have on that software is to be able to pull down satellite imagery for the property in question, and it gives me all of the measurements, the dimensions for the roof that I'm wanting to estimate, or the property that I'm wanting to take a look at. And then I have macros built in my software I just have to click a button on top of that dimension that was built into my software, and I can know what roof cost is, siding cost, window cost, and even floor plan cost within a matter of about, once I order the report, I can do all of that within about an hour. And if for some reason I cannot get the satellite imagery, I can go into an app, go to the property with my drone. It'll fly my drone, go around the property, take photos all the way around, and build the 3D model from my drone photos and import it into my estimating system.
Well, that's been very valuable for us and on many different levels. And thank you for sharing that and introducing yourself to the group here. I know several people have seen you kind of, coming in and out of some of the topics and being involved a lot. So I appreciate you being on there with us. And Yona, I'm going to go ahead and turn it over to you. I think we've got the people that are with us are going to be with us the rest of the webinar. So let's go ahead and dive into this topic of cost segregation and some of these tax strategies. And I may interrupt you in the middle if I want to interject or add something, but I'll let you go ahead and take it away from here. And if I don't, then we'll talk some more and have some questions and answers at the end.
Okay, awesome, Dan. Thank you again, Dan, and thanks, Brandon, for giving a little overview of what you guys are up to with Hanford Capital. And very grateful again for hosting me on this webinar. I'd love to give over what I know, and we'll get right into it. And thanks again for all the people who joined over, especially some of my LinkedIn followers. If you want to find me afterwards, that's the place to find me. I'm pretty regular in posting there and learn a lot more about cost segregation and other topics. So let's delve right in. Okay, so cost segregation is an amazing tax study. I just talked a little bit about our company, Madison Commercial Real Estate. I'm not going to get into that too much. We're a national company, cost segregation, title insurance, 1031, a bunch of other stuff. Contact me for that later. Cost segregation in a nutshell, it's a tax strategy that allows anyone who owns an investment property that is not a residential owner-occupied, basically excluding single family or multifamily that you actually live in a unit, an investment property or any property that you operate a business in, which generates revenue, you can use the depreciation, which we'll get into in a second what that is, to create greater cash flow and use it as a major deduction tool in terms of lowering your tax liability, your overall tax liability. So what is depreciation? It has a really weird name, and before we even get to that, cost segregation has a really weird name. I don't know if anyone thought about that before, but when I first came into the field, it was just like, what is this? It's cost. Why did the IRS give it such a weird name? Now, one of my colleagues like to say that it's kind of to turn off people from doing it because the IRS knows what an awesome strategy this is. And even though they don't require you to do this, which we'll maybe understand a little bit why further on, but they do recommend it. And since the IRS initiated this and put all the rules and set forth all the rules, they want you to do it, but they don't require it. So maybe the name is kind of the deterrent, maybe not. And depreciation itself is a kind of a negative concept. We think of depreciation, it means something goes down in value, right? And the concept really comes from the fact that when you buy a property, from the day that you buy it, it goes down in value. Similar to when you buy a car and you drive it off the lot, everyone understands it immediately goes down in value. Even though there isn't really intrinsic value that's gone down, because 1 minute to the next, right, 1 day to the next, 1 month to the next, there's not really so much value that's dropped. However, for tax purposes, the IRS allows you to take a deduction based on the value that you bought the property for and follow that through all the years of ownership of that property and deduct an amount, which is, for commercial properties, is divided into 39 years, and residential rental properties over 27.5 years. So residential rental properties includes single family, multifamily, and commercial includes everything else under the sun, whether it be retail, industrial, right, hospitals, you name it, golf courses, any property that you own that's an investment. And there's a need to capitalize this as opposed to just using it as a complete write-off, right? Meaning you can't take the value of the property that you bought today or tomorrow and just write off like payroll and rent, things like that. It's a write-off. So that's what we're going to get into. Depreciation is a tax write-off that allows you to take the value of the property you bought it, divide it over either 39 or 27 and a half years, and deduct that amount from your income tax every year to offset that. So I'll take an example, and we'll go into a little bit more. Let's just take an example before we get into what cost segregation is. The example is, let's say you bought a property for $1 million. So very simply, if you divide that by 27 and a half, that's going to give you a deduction of about $35,000 per year. That means that's the amount you're going to take off from your income tax before getting taxed on that amount. That's depreciation in a nutshell. Cost segregation means that you're allowed to reclassify certain assets within the property to faster depreciation lives, which means either what we call 5-year property or 15-year property. 5-year property includes anything that's in the building that's not part of the main structure of the building. So if you think of an apartment building, which we're in multifamily nation over here, so we're talking about residential, you have appliances, you have furniture, and that seems pretty simple, pretty straightforward that those things are movable objects. But when it gets a little more complicated and why you're going to need an engineer, a cost segregation engineer to be able to evaluate the cost is because there's things like fixtures, carpeting, special purpose electric, certain signage, things within the building, even millwork, even simple little things. And I'll show you a list as we go down, which actually comes from the Internal Revenue Code. What those things are, there's so much value within that that you wouldn't necessarily even think it has value. You think, okay, I have a building, and then I have, you know, a couch, and I have the appliances. The appliances, I know how much they cost. The couch, I know how much it costs. But how much, if I bought the building, how much do all of the fixtures cost individually? Now, when you're constructing a building, it's much more straightforward, much more clear. And part of the job of the engineer is a very fascinating thing that they're actually, according to the rules of the IRS, actually called upon to take a property that has been purchased and reconstruct it on a value basis, at least on a kind of, I guess the word is a budget sort of way, and look at it in terms of, if I were to reconstruct this property right now, how much would everything that's inside of it be worth? And then determine those costs kind of retroactively, reverse engineer the property. So that's a really cool way that the engineers go about doing it. Now, 15-year property includes pavement, landscaping, fencing, signage, all kinds of things, curb, if you have even stuff that's outside the building, like even if you build a playground or a swimming pool, certain things in that has value into it, and those things can be depreciated over a faster life, over a shorter life, and allows you to get those tax deductions in the early years. So 5 years is a much more shorter period to take deductions than over 27 years or 39 years. However, now we'll talk about later on about bonus depreciation even allows you to take some of these things within the first year of ownership. So that's going to be really cool. Let me go on here. Who can benefit from a cost segregation? So individuals, estates, trusts, corporations, partnerships, LLCs, any type of business partnership can benefit from this. A nonprofit, if you're a part of a nonprofit that is not taxable, there's no tax, so therefore there's no tax deductions of depreciation. A very interesting thing, which maybe I'll touch upon shortly, is the difference between IRA account. A lot of people are doing lately investment strategies using their retirement funds. So there is a huge difference when it comes to different types of retirement funds. I'm not going to too much detail into it right now, but there's a difference between IRA funds versus 401k funds. IRA funds are usually taxable. 401k are not subject to the business tax, so therefore they would not be taxable, would not be able to benefit from the cost segregation without that deduction. If anyone has a question about that later, please feel free to let me know. Okay, let me just make sure no one's asking any questions over here. Okay, great. Keep going. Here we go. So like I said, if you're buying a property, if you're constructing a property, if you're doing renovations, and this is where it comes really big benefits. And I spoke to a guy last week and he couldn't believe it. He was actually laughing out loud that he discovered this. And when you buy a building, let's take our example of buying a multifamily property for $1 million, a pretty good deal if you did, especially if it's a large property. And you decided, I'm going to do cost segregation. I'm going to hire an engineer to take this property and break it down into its components, show me what the benefits are, and accelerate those depreciations, take that depreciation deductions at a faster life. So instead of $35,000 a year of deduction, right, you may even get double that. You may get $70,000 or $80,000 a year in deduction over those first 5 or 6 years. Now, what happens if you decide to do renovations? This is a great tool. Everyone should really write this down because people forget about this. You can actually get double, even triple benefits, tax benefits, by doing major renovations in the property. How does it happen? Let's say you buy that property for $1 million and you decide to do some major CapEx, right? Capital expenditures, value add, that's what the strategy is, not just raising rents, but maybe, replacing all of the kitchens. Okay, so that's going to be a big expenditure of, let's say, you're going to put in $300,000-$400,000 into this property. When you buy the property, day one, you can do cost segregation, accelerate that depreciation, get those tax deductions the first year of ownership, and then you go ahead and dispose of all of the assets, dispose of all the kitchens, dispose of the carpeting, whatever you're going to be replacing, those assets that you're getting rid of, throwing in the dump, you can write off the value of those. Albeit minimal, it's going to be minimal value left in that kitchen that you're throwing out, but there's still something there. So don't forget that you can write off the value. It's an immediate write-off. And then when you replace all of the kitchens and put in brand new kitchens, and you spent $200,000, $300,000 on doing that, you can go ahead and do cost segregation again on the new appliances, the new furniture, whatever it is that you put in, and get the accelerated depreciation on that new stuff as well. So it's really double dipping. It's getting a double benefit, something that a lot of people don't realize they can do. Now, again, we said newly constructed, definitely something to do. Why within the past 7 years? Because when you think about it, if we're taking the property within the building that depreciates over 5 years and we're accelerating that, so after 5-6 years, that stuff has already been fully depreciated, and there's not much left except for the 15-year property, the stuff that's outside the building, which can be significant depending on the property, but it's not going to be as significant as the 5-year property. Now, some people ask me before we get into this, more details, what percentage would you say is the 5-year property or 15-year property within the cost segregation? Now, every property is different, but we find generally between 10% and 30% is the general window of how much of the value of the property is actually accelerated to a faster rate. Now, some properties can get even more, and one property that most people wouldn't even think about is actually really cool is a golf course. Golf courses, even though they seem like it's all land, it's really mostly land improvements. So sometimes up to 80% of the value of the property can actually be accelerated over a 15-year period instead of a 39-year period. So that's a huge tax write-off right there. This is just some history about cost segregation. I'll give you a little history. It really was initiated as to what it is today, at least the grandmother of what it is today, in the mid-1980s. And there were some different forms of cost segregation beforehand, what used to be called component depreciation and things like that. But there were many cases, many court cases, and some of the most famous ones were Whiteco Industries versus Commissioner, the Morrison Inc. Corporation, Petco Foods, and all these things came to help bring cost segregation what it is today, which allows us to follow the audit guide and bring about major tax savings and things that wouldn't necessarily been able to be written off. And I mentioned before, like appliances and furniture are pretty simple. You can buy them, you can move them around. Things that are movable, it's pretty straightforward that they're 5-year property. What about things like carpeting and fixtures? They're really attached to the building. However, they're attached, but they're not considered part of the building structure which depreciates over that 27.5-year, 39-year period. And some of these court cases came about and allowed us to follow through with that and do that as we do it today. Here's another great way to use cost segregation. People ask me all the time, when is the best time to do it? When is the best time to do cost segregation? And I usually tell people, as soon as you buy the property, or as soon as you place the property in service if you're doing a new construction. And the reason why that is because you get immediate tax benefits. And part of the major benefit of cost segregation is what's called the time value of money, which means that it's true. If you think about it, you're not getting more depreciation than you would have. You're just getting a lot of it in the first few years, in the early years. So think about it this way. It's like Uncle Sam is giving you an interest-free loan, right? That $1 million property, right? You could depreciate 37. He's getting, take this off $30,000, $35,000 a year. But what happens if you do cost segregation? He says, take off an extra 35,000, an extra 50,000 a year. And that means that you can get that money up front. You're going to have to pay it back over the course of 27.5 years if you pay that property. But I don't know about you, but if you want to give me, if anyone over here wants to give me an interest-free loan for about 27 years and I'll pay it back in small installments, I'm happy to do so. I think everyone knows that with the money, the cash flow that you have in your pocket, you can usually do a lot more with investment-wise than if it would be in the hands of Uncle Sam. So, however, you don't have to do the cost segregation in the first year of ownership. You can do it in a property that you bought in previous years. And this is something that what's called catch-up depreciation, catch-up deduction, or we call it a look-back study is kind of what we've coined it. And this allows you to kind of look back, get all the depreciation that you missed in previous years. You don't have to open up previous year's tax returns whatsoever. There's a simple form called 3115, as you see here on my screen, 3115, which allows you to get a simple form you fill out and allows you to go just change the method of depreciation. A very interesting thing, there's actually, I just quote over here a great book, one of my favorite books from Tom Wheelwright, Tax-Free Wealth. If anyone wants to write that down if you haven't read it yet. Great read. And one thing he says over there, there's actually, in this form 3115, 3115, there's two different types of change of depreciation method. There's changing it from a wrong way of depreciating your property to a right way, and there's changing it from a right way to just an alternative method. And there's something called alternative method, something called an alternative depreciation system, which applies in certain cases. However, when you're looking at cost segregation, that's actually called changing from a wrong way of depreciating your property, doing it straight line, just taking over 27 years, to the right way of doing it, to splitting out the property into 5-year, 15-year, and 27.5 years. So that's really interesting, really fascinating. He points that out in the book there. I actually really didn't know that till I read that. It says it on the form, but I didn't realize how amazing that is, that the IRS actually wants you to go ahead and do this. Okay, a couple more things. There are a few other things that may come into play when you're doing a cost segregation, right? There's something called a basis step up. Let's say if a person inherits a property, there's a step up in basis, which means that even though, let's say, grandma, bought this commercial property for $1 million 50 years ago, or probably for $10,000 50 years ago, but today it's worth $10 million. So what you do, even though it's fully depreciated, but when you inherit that property, it's not sold to you. You look at it at the fair market value of the property, which would be $10 million, and that's going to be the new basis. So now we're going to do cost segregation on the new basis and not the property that was fully depreciated. Something people don't appreciate enough, and I love appreciation is something people want to do in real estate, but just people don't appreciate the fact that you can get so much benefit from cost segregation because it starts on day one when you buy the property. You might think, well, this property was built in 1917, like how it's fully depreciated. No, the depreciation starts day one when you buy the property or inherit the property in that case. Now, what happens if you do a 1031 exchange? This is a little more complicated, but I'll get a little in depth for the sake of it. For some people who have asked this question, there's also called a step-up basis when you do a 1031 exchange, because in property A that you are selling with the 1031 exchange, the like-kind exchange, to roll over the capital gains, that property, let's say, had a depreciable basis, meaning you owned it for a few years and you already depreciated some of it. So whatever you depreciated on property number one that you're selling, you can no longer take that depreciation when you're going and moving it into property number two. So even though, let's say you bought the property for $1 million, 2-3 years ago, and depreciated $35,000 each year, right? So let's say you took off, just for simple math, $100,000 in depreciation over 2-3 years. Okay, so now when you roll that property over, let's say you sell it for $2 million, you're getting a big gain, which you're going to be able to roll over into another property. However, the basis, you have to subtract whatever you already took in depreciation in previous years, and only that amount carries over into the second property. However, the second property has a new basis for $2 million. So you just have to subtract that $100,000, which was the 1031 difference, or if there was a certain amount of gain in that as well, you subtract that to get your new basis for depreciation purposes. Okay, placed in service date is a very important point here, which means that if you bought a property on January 1st, so you have the entire year to depreciate the property. However, you bought a property on December 31st, you actually only get like a little bit of depreciation for that year, and that makes sense. You don't get a full year's of depreciation just because you bought it in that tax year. Tenants in common, this can get a little complicated, but it's actually good to know. It's another form of a property ownership if you don't know what this is. It's similar to an LLC, which is just it splits the ownership up into different ownership. However, it's a little more complicated and allows you more of a tax shelter for each individual to be looked at totally differently. So this is actually people use when they're, let's say, two different investors are investing together in a new property, but one of them is rolling over from a 1031 and the other one is not. So so a lot of times they'll use a TIC, a tenant in common, in order to solve some of the tax problems that would be involved in joining a new LLC when part of the funds are from a 1031. Or any questions on that, please put in the notes. Okay, this is something a lot of people ask, and even before I get to this, there's something called an active real estate investor or an active real estate professional versus a passive real estate activity. And this is very common. Dan, I know you are doing syndications, and a lot of investors in syndications, as everyone knows, are usually not active real estate professionals, which means their main business, more than 50% of their hours spent, are not in real estate. They usually have a W-2 job or have another sort of corporate job or what have you that's involved in, and they want to use those money to invest to make money in real estate. However, they can only, since they're only passive investors and they're not active real estate professionals, they can only use the depreciation, which is called a passive deduction, to offset their passive income. So let me say that again. Because a lot of high net worth individuals are going to be investing in real estate. And Dan knows this, and he can reiterate this later, but high net worth individuals, a lot of times they'll even have other passive investments. So let me just start again. A real estate professional is allowed to use depreciation and accelerated depreciation to offset both his passive income, that means the income produced from passive investments like real estate, and as well he can use those deductions to offset any other type of income. So let's say a guy's a real estate broker, right? He owns a property. So all of his activity in real estate, even though he's brokering property and getting huge commissions in that, he can actually use the deductions created from cost segregation to offset all of his other income because he's classified as a real estate professional. which the IRS defines as someone who's spending more than 50% of his time in a real estate profession and at least 750 hours of his time. This is one, if you're filing jointly, only one spouse needs to be this, which is an awesome tool. If you and your spouse are investing in real estate, or one of you is, you can use both of your joint income as a real estate professional to offset, depreciation, to offset all the other income. However, a passive real estate investor means someone who's not an active real estate professional can only use depreciation and accelerated depreciation, called cost segregation. I'll just say it like 20 times until no one knows what I'm talking about anymore. Cost segregation is creating much more income tax deductions, but if you don't have if you don't have enough passive income, you can only use those deductions to offset your passive income. The rest of it will be put into what's called a passive loss. And even though it will be carried forward, meaning that amount that is created a loss can be carried forward. However, there is a little bit of a complication in the new tax law that put a little bit of a damper on that, which only allows 80% of the income of the passive loss to be carried over into the next year. So you do lose out a little bit. However, most real estate investors and most people who are doing syndications, it usually benefits enough people involved to do the cost segregation. And basically every single multifamily investor that I know, every single real estate investor I know is doing cost segregation. They're not necessarily doing it with our company, but there's a lot of companies out there like ours that are doing it in a very professional way. And they're doing it because they understand the benefits, even if it's not for everyone involved in that syndication, is not maximizing those benefits, but for enough of the people it is. And especially those high net worth individuals are getting major benefits because they can use depreciation to offset any type of passive income, whether that be from real estate, whether it be from stocks. Bonds are also considered passive income. You're making money from that. Other type of passive businesses may even be considered passive income, which can be used to offset, which depreciation can be used to offset that. Okay, next point is, this I kind of went into before, which is the fact, it's a little bit complicated, which is the fact that the engineer actually has to reconstruct, sort of in a kind of metaphysical way, if you will, reconstruct the property as if the property that was purchased today was actually reconstructed today. And that allows them to find the value in all the different components within the property. That's a pretty cool thing. And I'll show you actually the numbers inside in a sample study very shortly. Once we get off this page, I'll show you a sample study where we see that actual breakdown. The next point, which is, this is the useful life. Again, this is something we spoke about before a little bit, which is the fact that, property that is bought has within it 5-year property, which means that, the carpeting is only going to last for 5 years. And even if it lasts more, that's what the IRS defined it to be. So every single thing that's in a property has a useful life, and it's actually delineated into extreme detail in the IRS, what's called the Cost Segregation Audit Guide. I'm just going to leave this page for a second just to show and pull up my page. This is from the IRS website, and I can give you this link. This is what's called the Cost Segregation Audit Techniques Guide. I just skipped to chapter 4 to show you some principal elements of a quality cost segregation study. But one thing that you can find here is all of the rules and all of the requirements to do a cost segregation, proper cost segregation study. And these are all hyperlinks, which you can see on my screen. That means that this is, like the IRS, is very detailed. We'll get into everything. What is a quality cost segregation? You'll see it has to be prepared by an individual with expertise, the detailed description of the methodology, use of appropriate documentation, interviews, et cetera, et cetera, et cetera. It's very complicated. So let's get back to the deck for a minute, and we'll see if we can finish this up and then take some questions. So, okay, let's get into what's called bonus depreciation. This is a new law that passed in the new Trump tax reform back in December, which gave a date of September 27th, 2017. If a person bought a property, let me take a step back, okay? we spoke about 5-year property, 15-year property. If you don't remember what that is, you can raise your hand. There's a way to raise a hand over there. I can repeat that. 5-year property, or if people weren't here before, is stuff that's within the building, which isn't part of the structure, which can be defined by an engineer. And the 15-year property is stuff that depreciates over 15 years, which is outside the building. So that will include landscaping, fencing, pavement, parking lots, all that stuff depreciates over 15 years. All of that is eligible for something called bonus depreciation, which allows you to take all of that depreciation in year number 1, as opposed to spreading it over 5 years or 15 years, which would be done with the company. Now, what Trump did was that 2 things. Number 1, it used to be you could only take bonus depreciation on a newly constructed property, something that was placed in service for the first time. So this was done, generally speaking, by construction. People were buying new buildings, people were developing new buildings, people were doing major renovations. The stuff that was placed in service for the first time by anyone, that could be eligible for bonus depreciation, but only 50%. That means take the value of all the, let's say, carpeting, for the example, right? You have $100,000 worth of carpeting in a building. If you would do cost segregation, you would take that value over 5 years. So you get $20,000 a year to depreciate that property. And if you did bonus depreciation, previously you could only take $50,000 of that in the first year, and then the rest of it you'd have to depreciate over 27 years. And now you can take 100% of that. So the date that was given is September 27th. No one really knows why that date was given, but if a property was purchased after that, and now it's actually next week, it's too late to take advantage of this, because the other main point of cost segregation is that it has to be done within the first year of filing taxes, so the first tax year, which means if you didn't do it already by next week, October 15th, individual LLC or individual property owner, so it's too late to take bonus depreciation on a property that was purchased in 2017 after September 27th. Okay, and this will phase out in 2023. That's at least for now what was written in the tax law, and this is kind of this is what I just said. Bonus depreciation allowed first year. Any property, even if it was bought by you, not just developed by you, not just constructed by you, but even an old property that was bought for the first time, you can take bonus depreciation. It's a huge game changer, huge deductions. Someone asked the question, what are the reasons you would want to take the entire depreciation up front? With the bonus depreciation, what happens on years 2 and 3? That's a great question. And the answer to that is, if a person has major income, right, from all kinds of sources, and let's say a person is not just, this isn't the one sole property that he's going to be owning for his whole life. So number 1, again, you're not taking the entire depreciation of the property, you're just taking those 5-year and 15-year assets. So let's give a number, round number, 20% of the value of the property. So that $1 million property, right, you could take it for potentially a $200,000 deduction this year. Now, if you made $1 million this year, you don't really necessarily, most people wouldn't want to have to pay taxes on that $1 million if they didn't have to. Only pay taxes on $800,000, that'd be a great choice. It pretty much keeps not the entire amount, but that, which is, let's say you're paying a 25% tax rate. That's an extra $50,000 in your pocket cash that you're not paying to the IRS. So there's a lot of reasons why people would do that. Someone else asked, what about, can you carry forward the bonus depreciation? You can, if it creates a passive loss. However, like I mentioned, it doesn't necessarily benefit you in the previous years because of the new tax law that only 80% of that is going to be able to be carried forward. Let me get back to the great questions. Thanks for asking. Let me get back to the deck. Let's see what else we got to cover here. This is just a chart that shows you at 2033, it's going to go down to 80%. It's not going to be erased entirely. It's going to then 60%, 40%, and going to go down like that. What else we got here? Okay, how do you select a cost segregation company? And this is something very, very important. Oh, we have a question and answer box as well. How does passive losses Ryan, awesome question. Let me get to that at the end. Just I want to get to this point here, if we didn't cover that already. Here. So you need to ensure that, and this isn't coming from me, this is actually, let me go back to the IRS webpage. How do you select a cost segregation firm? Back in this IRS webpage over here. Principal elements of a quality cost segregation study, prepared by individual expertise. So if you click on that, you'll see what actually you need to have. You need to have someone who has an engineering background. They understand what's going into the study. They have experience in that. They understand the entire audit techniques guide. And it's important that they have not just engineers, but tax accountants. Now, a lot of big tax firms, talking about the Big 4, Big 10, they have engineers in-house to do this. A lot of firms will outsource this, which can be problematic in communication and not getting, if the accountant is conversing with the client and the engineer isn't getting everything straight in, not everything's upfront, it can be confusing. So that's why a dual in-house focus is really important. They have a feasibility study, which what I'll show you in a second. Here's a feasibility study. This is what we'll do. Anyone who owns a property will give an upfront complimentary study, which allows you to see the benefits. We'll project based on thousands of properties we've done like this. We'll project what the benefits would be even before doing a full study. So this allows you to see, right, if I would do non-cost segregation, right, this would be my depreciation over the first 6 years. This was actually for a property that was purchased for $9.75, a multifamily property. There was actually a 1031 involved, so the basis is a little less. But if I were not doing cost segregation, my deductions would be over the first 6 years, 1.3 million approximately, and with cost segregation is going to get up to 2.5 million. You can see what those deductions would be, and here's like how much 5-year property is going to be 19%, 15 property is going to be at 7%. And this, our engineers actually prepare this ahead of time, looking at the square footage of the property, how many units are there, etc. Like I said, based on the full studies that we've done before. And then you can see an example of the depreciation schedule, what it would look like. This over here would be, here, like this. No, I'm not going to use that. Spotlight, that's what I want to show you if anyone's looking here. The non-cost segregation, this is what a depreciation schedule would look like on this property. Here's the straight line, $250,000 each year. But if you did cost segregation in year number 1, instead of 116, you get 229. Year number 2, 700, 500. So you're getting a lot extra. Is depreciation different each year? You'll notice in year number 7, it starts to reverse itself. You're not going to get as much. Now again, instead of 250 of depreciation in year number 7, you're going to get 217. There's still a significant amount, but a lot of that gets, the rest of it gets spread over the next 27 years. So we'll go ahead and prepare this before. And this is a very important point that most firms do. And what about audit defense? This is also extremely important. What happens if a person, God forbid, gets audited by the IRS? No one wants that to happen, but it happens occasionally. So you want a firm that's going to stand behind their reports. They're going to do everything according to the law and according to the tax guide and can support it. Not only that, we'll offer audit defense at no extra charge to stand in front of the IRS if asked to. And for us, we've been in business for 13 years already, and our studies have been reviewed a few times in audits, and basically they just 100% no change. They'll just look at it and see, okay, it's good to go. We don't need to ask any questions. Everything that we need is within the study, and that you need to have, because you don't want, God forbid, and it has happened to people that just do guesstimates and they try to do it by themselves and they don't have the proper documentation. It just gets thrown out, and that's no one wants that with the fines that come along with that. Well, maybe some people don't mind the risk, but I would imagine. Okay, here's some things that we'll need to go ahead and do that. I see we're running out of time, so I don't want to, there's not really much more over here. The closing statement, a cost segregation study creates an income tax benefit for investment property or for any other income generating property. Huge cash flow. Now I guess we'll take the floor for questions. And here's my contact.
Yeah, so thank you, Yona, for providing all this information. I've been, I know you haven't been watching the Facebook feed, but lots of good feedback, lots of great compliments, and I know the people who are listening on the Zoom platform as well are are thankful for you being on here and sharing this, because cost segregation is one of those topics that a lot of times it's misunderstood. You know, we go to seminars and, you know, we hear people when we're networking talking about cost seg and cost and what kind of tax advantages it is, but there's a lot of rumors out there that really you've really cleared up for me, at least, and I know a lot of people out there that are listening and watching the webinar right now are thinking the same thing. So those of you who are on with us, whether you're on Facebook or whether you're on the Zoom platform, please, you know, make some compliments to Yona and tell him how much you appreciate him being out tonight. It's a late night. We're all after a long day of work out here doing webinars. So thank you for coming out here. I actually have a couple of questions myself, Yona, but I'm going to have Brandon queued up here, and I'm going to have him discuss some of these questions that have been posted on our Zoom platform. And then if you're on Facebook and you have a question for Yona, please go ahead and put it in the comments, and that way we have it available for you to be able to answer those for the listeners. So Brandon, just make sure you unmute your mic, and you're on right now.
All right, so Yona, thanks again for that content. That was excellent. And so we obviously have some questions after all that content. And Ryan Gibson wanted to know, how does a passive loss pass through to a passive investor due to cost seg impact the W-2 earned tax liability? Assuming the passive investor owns a percentage of the asset and is given passive losses by the operator project sponsor.
Excellent question, Ryan. So the way this happens is according to the percentage of ownership of the property that is within the LLC in most cases. So that the depreciation overall, whether it be regular depreciation or accelerated depreciation, is passed through on the K1 distributions, which every single investor gets their amount of, you know, both the income and the losses and everything that goes in there for that property. So each property gets that. Again, passes through the K1. And I think what you're really getting at is, do these, how will it impact their W-2 earned tax liability? So we mentioned beforehand, I'll just reiterate it here because it is a really great point, which is that, again, the slide we mentioned before is that a passive investor, which means someone who is not considered a real estate professional, which again, defined by the IRS as someone who spends more than 50% of their time and at least 750 hours of their time per year documented in real estate professions, some form or another, whether it be managing property, whether it be, you know, brokering property, whether it be owning property, but it has to be, so anyone who's not that is what's called, you know, in your case, your example, a W-2 worker, right? A non-real estate professional can only use those passive losses to offset any passive income that they might have, whether it be from their real estate or whether it be from any other passive income they're earning. Did that, if Ryan, if you're still on, you can tell me if that answered the question or not.
Okay, and then Ilo had a question about the slides.
Awesome.
She found that very informative, and she was wondering if she could get, if the copies of these slides were available.
Yeah, Ilo, thank you so much. You see, if you're on the screen here, you have my email address here. Please send me an email. I'll be happy to email you the slides for that, and anyone else that goes for too. You have my phone number. Please copy down my contact information if you want a free study, a free feasibility analysis on one of your properties. And this, I guess we'll close the question box here. Everyone should.
I actually have a few questions coming in from Facebook as well. So that was answered those on the question box on the webinar. But Jeff Hamlin wants to know, what if I 1031 exchange into a property earlier this year? How does that impact the opportunity?
Great question. It will impact it depending on how much the property that you sold, that you exchanged, how much basis was left in that property. Okay, so again, we spoke about before, the new property that you buy, usually without a 1031 exchange, the property, the basis, which means the amount that's depreciated, is taken by looking at the property, how much you bought it for, subtracting land, which actually I don't think I even mentioned over here, but that's really important to point over here. Land is not depreciable. So usually there's, a percentage, 15%, 20%, whatever that is, that you subtract from the value of the property. So on a regular property, that's just going to be the value, the purchase price minus land. That's going to be your basis. However, when you 1031, which is your question, is that there was a basis from the previous property that you already depreciated a bunch. So that carryover is gonna be affected, which means that, let's say you exchanged $1 million into a $2 million property. So whatever you already depreciated is going to be deducted from that to your new basis.
Excellent. That was a great answer. And here's a couple more questions on that. So if you acquire a property and you have appliances in that property and you're going to start depreciating them from day one, and then you go in and you're going to upfit, you're going to value add that property, and you're going to get rid of all those appliances and replace them. Do you get a write-off for the ones that you got rid of and then start depreciation on the new ones that you now have put into the building? How does that work?
Right. So we mentioned this also before, but I'll reiterate it because it is a really excellent point. I think we've talked about this towards the beginning, which is that when you depreciate from day one, the property you bought, all those appliances, all that stuff, 5-year property gets depreciated. Now, if you do cost segregation and want to get that extra value within the first 5 years, you can do that. Do a cost segregation report. Now, when you dispose of, you do the renovations and you go and upgrade that, you can write off the value of whatever you're throwing out, whatever you're disposing of, whatever's left in that. It's not going to be a full value. It's going to be minimal value, but that's just a tax write-off. Okay. Third step, right? Again, step number one, you did the cost segregation. You got the accelerated depreciation on the new property you bought. Step number two, disposing of property, renovations, tax write-off of the minimal value that's left in whatever you dispose of. Step number three, do a cost segregation, accelerated depreciation on the new stuff that you put in and hit it up for, double whammy.
Excellent. That was a great answer. And I think the last question that I have on my list is, some people have mentioned this to me, tax credits, and I've heard these being included in these cost segregation reports for improving efficiency. So if you put in all these new appliances, and now you're more efficient and you cut down on the electric bill or the heat bill or whatever, is that something that's included in the cost segregation study?
No, it's not. It's actually something else. It's an entirely different part of the tax code, which sometimes can be a great supplement and sometimes can be a great addition to tax benefits on top of the cost segregation. So I actually have a good friend out in California, in Southern California, who does that, tax credits for different energy efficiency property and stuff like that. It's really amazing, and he loves that, he can add on to extra value to that. I do see here that Ryan Gibson asked that awesome question here in the notes, which I meant to get to, but I just blanked on it. It is a really, really, really important question. So Brandon, please go ahead and ask that.
Sure. So yeah, Ryan wants to know, once property is fully depreciated, for example, 5-year property is completely depreciated, is there any recapture at the sale of the property? Excellent
question. Okay. This is a very important point. I should have mentioned. It's one of the most scary topics when talking about taxes. It's something called recapture tax. Yeah, the IRS doesn't love you. Wake up. Okay, good morning. Anyways, the IRS says, yeah, you can take these awesome deductions and get the cash flow in your pocket. But guess what? If you sell the property, you have to pay tax on the amount that you took. You don't have to pay back the depreciation, but you have to pay tax on it. That's called depreciation recapture tax. No fun, but listen, you can't have fun all day long. Anyways, it works like this. When you depreciate a property, right, you take those deductions. Upon the sale, you have to pay a tax on it. That tax is usually less than the income tax that you would have paid anyways on that value. It's capped out at 25%. it depends on the, has to do with the capital gains rate, but not exactly the same. However, two things. Number one, if you're doing a 1031 exchange, there's no depreciation recapture tax, just like there's no capital gain tax. I'll say it again, if you're doing a 1031 exchange, there is no depreciation recapture tax, as well as no capital gains tax. That all gets rolled over to the next property and is deferred. Okay? It's not written off, it's deferred to a later date. But the question is, what about you did a whole lot of segregation? After 5 years, if you own a property for 5 years, you really, all of that property is in actuality, it's been fully depreciated. So if you look at it, there's really no value, there's no intrinsic value in it. So there's a very interesting way to do it. There's a few different strategies. This isn't necessarily the only way to go about doing it, but you can actually, upon the sale, apply lesser value to the 5-year assets that you depreciated fully. So let me repeat that. Let's say you bought the building for $1 million. You did cost segregation, took out $200,000 of extra depreciation, and upon sale, right, you'd have to pay that extra $200,000. You have to pay a tax on it, say 25%. But that's only if you look at it at the full $200,000 value. But if you fully depreciated it, you can actually apply a much lesser value to that, which a number of tax firms do that. I'd be happy to discuss it in further detail for anyone who's interested. There's a simple form you fill out upon the sale of a property. And not necessarily in the sale agreement do you do this. I would not recommend that. However, there is a separate form that you can apply lower value to the 5-year property, which then allows you to take a much, much, much lesser bang on that depreciation recapture tax.
All right, so I have most of the questions that I had, and actually you answered along with all these other questions. So great questions from the listeners and the audience tonight. I have two things. First is not necessarily a question, but a clarification, and then you can validate my clarification if it's correct. And if not, feel free to correct me. But when you have high net worth investors that are taking their depreciation to offset some of their passive income to reduce their taxable liability, they're reducing that taxable liability from ordinary income if they are a real estate professional, and they're offsetting that ordinary income, and then upon recapture, it's taxed at the capital gains rate. So you actually are reclassifying the tax rate as well, even if you didn't 1031 the property and you had to pay capital gains, correct?
Right, correct.
Okay. The other question I have for you, which is a big question that a lot of people have, is at what point does it make sense to do cost segregation? Because obviously, to hire somebody like your firm to come in and do a cost seg analysis, it costs money. And so obviously you have to factor that into the underwriting and the modeling that we do on a project. So what would you recommend on a property? Obviously you would want to do it on all of them, but I know you guys are reasonable as far as like letting people know what is that figure, what's that set point of dollar amount or what they're looking for in the property. Sure. As far as to be able to do this. Absolutely.
So first of all, the cost for doing a cost segregation is actually not that much when you think about it. There are firms out there, large accounting firms, which will charge an arm and a leg. And the truth of the matter is, everyone did about 10 years ago, but the game has changed a lot over the last 5-10 years. And so competitive price for a cost segregation study in multifamily is usually somewhere between $4,000 and $6,000. You can ask around in the market, but I know that's what we charge, depending on the size of the property, the scope of work involved. Nothing to do with the contingency of how much savings there are. That's a big, big no-no. The IRS. That I'm doing this study for you, but I'm taking I'm going to make sure that you get a lot of deductions so I can get a percentage of that. No way. So that being said, the cost is not that much. And our firm actually made a rule this past year that they don't want to look at properties bought for under $1 million. Used to be, we used to do a lot of properties a lot less and do, send out estimates to tons of people, basically asking for, any type of property. And most people will come back and say, well, there's not really much benefit there. Yeah, well, duh, it has to do with the value of the property, and it's a percentage of that. So it makes sense that the more value, the more the property is worth, the more percentage, makes sense. It's just a numbers game. The more value there's going to be, the more benefit there's going to be there. So definitely over $1 million, there's significant benefit. I'm talking about like at least $150,000 of tax benefit there. So paying a few $1,000s to get that is really a no-brainer. Under $1 million, it's really a case by case. It does depend on a lot of type of the property. If it's a single family, a lot of people want to do it on single families. You have to understand there's not a lot there. When you're dealing with a multifamily, right, you have the same property value, but like multiplied, right? So you have, instead of one kitchen, you have, right, 100 kitchens. So all of that 5-year property is going to, even if the property is worth the same, you bought a $1 million house, and you bought a $1 million multifamily property, the same value, but there's so much more 5-year property in the multifamily. So it's really on a case by case.
And how when you guys are pricing, to do a cost analysis on a property, is the fee based on the size of the property, or is it based on the value of the property, or is it what are the other criteria that you guys look at for pricing it?
It's based solely on the scope of work. So it has nothing to do with the value of the property. It has to do with how big the property is, how many units there are. When you're dealing with other type of commercial properties like retail, like shopping malls, office buildings, it's much more complicated. Industrial, sometimes factories, much more complicated, much more work involved than a multifamily. Because believe it or not, a multifamily, there's a great law in the tax code that says that you only have to look at a certain number of sample units and then apply the findings to the rest, which means there's a lot less work involved. Whereas in an office building, you have to go into every single suite. So, it depends really on the square footage, and every suite is totally different a lot of times. And so, yeah, again, scope of work is what's involved, is what the pricing is at.
And how long does it take to complete one of these studies?
So for us, it usually takes about a week or two for us to schedule an engineer to actually come to the site. And that's a necessary factor. This engineer actually has to come to the property, do the full study, take a full report, pictures, video, details, everything that he does. And then from that point on, it usually takes between 2 to 6 weeks, depending on how much work there is and how much other work is going on. Like right now, tax season, it's just swamped. We stop about a month before taking new work, just so we can make sure that all the old work is completed. So yeah, overall, it's between about 3 to 6 weeks.
Okay, and once that study is completed, there's a document, and that document is just submitted to your accountant, not yours, but the property's accountant, and then they basically take that into the distributions from the investors and when they're filing at the end of the years.
Exactly, and we do all the work. The accountant really doesn't have to do any Excel file that you can just basically cut and paste and put into the depreciation schedule, ready to go, and that's it.
I have one final question, and it's about calculating and baking in somehow the benefits for certain tiered tax tiers and for high net worth individuals on the IRR. So obviously, a lot of us that are in the value add space, we are IRR driven, and we're trying to get the best IRR for our investors because we are syndicating these properties. And so I know some people I've seen can actually bake the cost analysis into adjusting the IRR based on somebody's investment amount and their actual tax rate. Right.
So just to reiterate your question, so you're asking how can you actually put the value of the cost segregation benefits into the IRR, into the business plan?
Correct. Yeah, because I have seen some people do that before, and I'm just wondering, have you ever seen people do that before? And to kind of, because you definitely have to break it down by tax bracket, because if somebody's putting in $100,000 into an investment and they're at, the top tier tax bracket, and another person puts 100,000 in and they're in the middle tier tax bracket, it's going to be a little bit different based on, what those are, correct?
Right, correct. Yeah, that's an excellent point. So there's something called net present value. So that has a lot to do with the tax benefits are going to be different, depending on the tax rate of the individual. So yeah, I have seen that. It's definitely doable. It's a simple, I think, Excel file to make that. And I think there's a lot of benefit in that. We have a number of investors, especially in New York area, that the second they even go into contract in their property, they'll order a cost segregation done. They're doing it, and they want to see, for their investors, they want to see what the benefits are going to be upfront, so they can already write that into their business plan to show their investors even before the property closes.
Great. Well, thank you so much, Yona, for being with us tonight and taking some time out of your evening to share this with our Multifamily Investor Nation group. I've gotten some great comments on Facebook. I know you're not looking at that right now, but we also have some great compliments here on Zoom. So as we're wrapping these things up, please continue to provide some more compliments and thank yous to Yona for taking some time out of his schedule. And if you have any questions for him, I put the links and the emails into the boxes. So if you want to reach out to him, get a copy of the slides, you can take his email and send it to him, and he'll be glad to share that with you. And if you want to reach out to him and see if he can help you out, tell us a little bit about what that process looks like, as far as if they have a property, they want you to do some sort of analysis maybe before they actually get you in there to do the actual full study.
Yeah, very simple. Send me an email, give me a call. Get my number, it was on the screen over there. All we need is really the property address, the purchase price, place and service date. And with that, our engineers can pull up the pull-up records and get enough information about the square footage, et cetera, of each property. And then it takes a few days and we'll get back that estimate, the feasibility analysis. And that's it. It's really pretty simple. And it's so necessary because until you see the numbers and be able to make the educated decision and see, wow, this really makes so much sense to do, it's kind of a little bit theoretical. So it's definitely worthwhile. Please reach out to me. You can find me by email. Obviously, LinkedIn is a great place to find me. And thank you again, Dan. I really appreciate you having me. And thank you for everyone who's watching and listening. It really was a pleasure. And I hope to be able to help many more in the future and spread the word. Tell your friends. If anyone wants to get in touch, learn more, I'm always open.
Well, again, thank you so much, Yona, for being with us. And, for those of you who are still here at the end, I have a slide up here with Adam Adams on it. He has an event coming up next month. There's a link inside of the comments on Facebook as well as on the Zoom chat box. And on the screen here, which is realbluespruce.com/OPM, stands for Other People's Money. That's all lowercase for OPM, realbluespruce.com/OPM. I've been invited to speak on a panel at that event, and I'm going to be there. And I've actually got my 6-year-old son coming with me. So I have 4 little children. I have a 7-year-old girl, Caroline, a 6-year-old boy, Caleb, so he'll be joining me. And then I also have 2 younger ones, a 2-year-old named Chloe, and then a 9-month-old Callie. So very busy time in our life right now, and so I like to travel with them as much as I can. So they'll be joining us. So if you'd like to meet me and maybe even meet my son there, we'd love to have you at that event in Denver. So use that link. I know the tickets right now are very cheap. They're like $100, $200. So you got to go to that event and surround yourself with the likes of Adam Adams. I know Kathy Fetke's going to be there. Tom, I think it's Wheelwright is going to be there. The accountant there. So make sure if you have the time and you're able to make it out to that event. And again, thank you so much, Yona, for being with us. And I hope everybody has a great evening.
Awesome. Thanks, Dan.